Hi, I'm Dave Nolan, Senior Investment Strategist at McKinley Carter Wealth Services, where we continually endeavor to help you master your wealth. Today, I'd like to highlight our first quarter market review and outlook report. While 2022 was certainly a challenging year for stock and bond investments, the first quarter this year was ultimately positive for both, despite competing forces causing wide swings in investor sentiment. Optimism surrounding declining inflation and the associated easing of interest rate pressures in early January gave way to greater than expected inflation numbers and strong employment numbers for the months of January and February. These factors led to a resumption of the upward trend in interest rates and downward pressure on stocks that we saw in 2022. In March, markets were initially roiled by the news of several bank failures brought on by rising interest rates and poor risk management at the banks. This led to the rapid exodus of customer funds from those banks as their deposit bases were dominated by uninsured deposits, that is, those deposits greater than the FDIC's $250,000 limit. But as the Federal Reserve, the FDIC, and the Treasury took steps to calm markets, stocks finished the first quarter on a strong note. As a result of the bank failures, banks will likely tighten lending standards and regulators may enact stricter supervisory standards going forward. This, along with the Federal Reserve's continuing to raise interest rates, makes it a close call as to whether the U.S. economy will fall into recession this year. The potential negative impact on consumer spending and corporate earnings could well be enough to trigger an economic downturn. On the other hand, the banking turmoil may convince the Fed to stop tightening soon and could also prod Congress and the administration into a less eventful raising of the debt ceiling, all of which could reduce recession risks. While manufacturing data indicates sluggishness in the economy, services continue to be strong as consumers are still going to restaurants and taking trips. Accumulated savings during COVID and a still healthy jobs market are allowing folks to spend more on experiences, but less so on goods. In total, GDP estimates for the first quarter of the year still forecast modest growth for the U.S. economy. As we've stated in our previous reports, many inflation indicators such as the Global Supply Chain Pressure Index, inflation expectation surveys, and commodity prices peaked last year and are headed lower, giving the Federal Reserve fewer compelling reasons to raise short-term interest rates from this point. As rates peak, there will be less pressure on both the stock and bond markets as investors begin to anticipate a lower rate environment over the next year. Evidence of this has already been seen in the positive market returns witnessed thus far this year, despite multiple economic and geopolitical challenges. While earnings estimates have steadily declined this year, the projections for next year remain robust for both domestic and international stocks. However, should the analyst projections be lowered due to more evidence of downward economic pressure because of additional banking concerns and rising unemployment, the stock market may give back some of 2023's gains. The primary competition for stocks continues to be short-term treasuries, CDs, money market funds, and fixed annuities. With these products yielding above 4.5% and corporate earnings estimates in doubt, many investors are now moving their dollars to guaranteed investments to reduce portfolio risk. Until the Federal Reserve clearly indicates their intention to stop raising interest rates, investors will likely continue to allocate significant assets to these categories. Despite some near-term earnings and valuation headwinds for U.S. stocks, we believe that over the next year we will see stocks outperform bonds as inflation continues to subside, the Federal Reserve stops raising interest rates, and the stock market anticipates an economic recovery in 2024. International stocks, which have been previously hurt by a strong U.S. dollar, have already seen a recovery this year as investors are taking advantage of a weakening dollar and more attractive valuations found overseas. In sum, while markets will be challenged by economic uncertainty and a Federal Reserve that continually moves the interest rate goalposts, we feel that inflation pressures will ease this year and the economy will avoid a significant recession. As markets look through near-term concerns about bank stability and corporate earnings and begin to focus on a likely recovery in 2024, accompanied by lower interest rates, the overall investment outlook is positive, in our opinion. Thank you for watching today, and please read our full market review and outlook report for greater detail on the first quarter and our forecast for the rest of 2023. Take care, and we'll see you next time.